Hello and welcome again. Previously, if you remember, we learned how to calculate the adjusted net income. In order to calculate the adjusted net income, first we needed to take the net income and we deducted the personal pension contribution out of it. So that's why we can get, that's how we can get the adjusted net income. Why we needed the adjusted net income? In order to calculate the reduced personal allowance. Also, if you remember, there was another benefit of personal pension contribution. It can enhance our basic rate band and the higher rate band. Right? Now, the formula, if you remember, to calculate the adjusted net income was, we took the net income and we deducted the personal pension contribution, and it was gross amount of personal pension contribution that we deducted. Another thing that we needed to deduct from the net income was a gift aid donations, which I did not tell you before. Now, the gift aid donation is simply a gift which you make out of your salary it is just a donation which you make out of your salary for charitable purposes. You can make it to different charities in the UK. Now, why government encourage you to do that? Because it is a charity. It is sort of a donation that you're making out of salary, which is obviously everybody encourages that, and just like that, UK government also encourages if you put some money, if you give some of your salary to the charities, so that they can think about the other welfare of the other society, right? So if you remember, adjusted net income was, we took the net income, it was net income, and we deducted the personal pension. Another thing that we need to deduct out of the net income is gift aid donation. Gift aid donation. So if any of these two come into your question, you need to take gross amount of both of these, and you need to deduct it out of the out of the net income in order to get the adjusted net income. Adjusted net income. Now, adjusted net income, why we needed this figure? If you remember, we needed this figure to calculate the reduced personal allowance, because the threshold was £100,000. If your adjusted net income is less than £100,000 or £100,000, then you will get 10,600 personal allowance. If it is more than that, then your personal allowance will be reduced and you will be eligible for the reduced personal allowance, right? So previously you knew that we took the net income and we deducted the personal pension contribution out of it, but another thing that we need to deduct is the gift aid donations. It is simply a gift out of your income which you give to charities. It is simply some little bit of amount that you donate to the charities out of your income, and then government encourages that. And likewise, you only need to pay some bit, you only need to pay 80% of it, just like the pension contribution. So HMRC is paying 20% of it. So say, for example, if you give £80 towards your charity, other £20 will be paid by the HMRC. So the charity will get £100, right? So it is another benefit, because HMRC says that you should contribute toward the charities, because the charities then work for the welfare of the society. All right? So that is the way to do it. Another benefit of personal pension contribution was that it enhances, it is added in the basic rate band and the higher rate band, if you remember, right? Likewise, gift aid donation is the same way to do with the gift aid donations as well. Gift aid donation will also be added in the basic rate band and the higher rate band, so it will also enhance the banding, basic rate band and the higher rate band. So if you see any of these two in the question, same treatment in here, and same is the benefit of these two if you think about the banding, basic rate band and the high rate band. All right. So that was it. Another thing about the personal allowance, if you remember, that we calculated the personal allowance, then we learned how to calculate the reduced personal allowance. Another thing which I missed was that you can transfer some of your personal allowance to your spouse as well, which is for current year the limit is 10% of your personal allowance. Say for example, if your income is less than £10,000, 10,600, then your personal allowance will be wasted. Remember, I told you that your personal allowance can only reduce the tax liability to zero, but it cannot go into negatives. So obviously your personal allowance will be wasted if your income is less than 10,600. However, what you can do is you can transfer some of your personal allowance to your wife or your civil partner, right? So if you transfer some of your personal allowance to your wife, then they can use, she can use your remaining personal allowance, and that's why she can reduce her tax liability. But the limit to transfer your personal allowance is only 10% of your personal allowance, which our normal personal allowance is 10,600. So 10% of it is 1,060. So you can only transfer 1,060 to your wife, and then she can save tax on that as well. Obviously, if her income is more than 10,600, right? So that was a little bit of another addition to what you already knew. And interesting point is that 1,060 will also be given to you in the exam. So it will say that marriage allowance, you can also call it marriage allowance. So marriage allowance is 1,060. You can transfer 1,060 to your wife, and then she can use this personal allowance and she can save some tax on that, right? Now, if you remember income tax pro forma from your first or second lesson, I told you that there will be non-savings, savings, dividends, and then we listed down the sources of income, all the sources of income, all the sources from which we can earn income, and we listed down all of them. Then we learned some of the exempt income and other stuff as well, which we do not list there. If you remember, and if you check your notes, please, notes are available on our website. If you download the notes, I hope you have already done that. If you go to page 2 of your notes, where the income tax pro forma is given, with non-savings, savings and dividends, after all the bits and pieces that we did, after all that, if you remember, and if you can see it on your notes as well, that there will be tax reducers, if you remember. Tax reducers, if you check on your notes, there are 3 types of tax reducers, which are major tax reducers. Which ones are these? First one is called EIS, Enterprise Investment Scheme. Other one is called SEIS, Seed Enterprise Investment Scheme. And the third one is called Venture Capital Trusts, VCT. Right? Now, today we are going to discuss that. Now, these are tax reducers, as you can see on your notes. These are called tax reducers because they reduce your tax liability. So after calculating all the tax, all the sources of income, then after deducting the deductible interest and personal allowance and everything, whichever your final tax liability is, before you're going to pay to HMRC, what you need to do is you need to deduct the tax reducers. So what does tax reducers do? That they just reduce your final tax liability. Say for example your tax liability was £1,000, then tax reducers, whatever they are contributing to that, your tax reducers will reduce that final tax liability, right? So that's the function of tax reducers. But how does it work? I will just show you in a minute. Now, in every country, I hope that you understand that getting a job, if you're going to find a job in a country, that is fine. I mean, many people do that. It is beneficial for the country point of view or not, that is questionable. However, if you come to the self-employed point of view, if you're going to do a business in a country, that is definitely going to help a country. From the other point of view, if you're going to be employed, if your skills are exceptional, then definitely it is going to help the country as well. But businesses always help a country. For example, after being qualified, there are 2 ways. If you go and work and find a job, you can do that. Another way is if after finishing your studies, you start your own business. That is fabulous. If you start your own business, you will not only be helping your own self, but you will be helping the other people to find the job as well. So that's why, from government point of view and from your own point of view, it is very, very beneficial. Because if you do not start a business, you are relying on the government because you are finding the job. So you will go to other businesses to find the job, right? On the other hand, if you start your own business, you will be independent yourself, but also you will be helping the country by paying taxes, not only by paying taxes, but also by providing the jobs to other candidates who are in the market, who are finding the jobs. So, to be short, that businesses always flourish. If the businesses are all flourishing, the country will become happier, because not only they will be paying tax, but they will also be creating some jobs, right? So likewise, the UK government says that you come to our country, and if you are from away, other countries, you come to our country and start the business. If you are within our country, if you are national, then you start the business instead of finding the jobs. If you are starting the business, then we will give you some benefits as well. Now, when I am going to start a business, I do not have much money. Say, for example, I have £100,000 or even less than that. Then how can I start a company? How can I start a good business? So the government says that you start your business, we will help you. How will the government help me? They will advertise. They will advertise to other people, asking them to invest in my business. So if they advertise and ask the people to invest in my business, if the government is asking, then I will get some money and I will start my business. But how will the government agree other people to invest in my business? Obviously, by giving some incentives. Otherwise, no one will come to my business to invest the money. If they're getting some incentives, then definitely they are going to invest in my business, right? So that's where the tax reducers and these investment schemes are come, which we are going to discuss now. Now there are three types of schemes which we are going to discuss now. First one is called Enterprise Investment Scheme, or EIS. Now EIS, or Enterprise Investment Scheme, what is that? I just wrote it down as EIS. You can write it down complete form if you want. It is Enterprise Investment Scheme. Now Enterprise Investment Scheme is a scheme whereby people around the UK, they can come and invest in this company. It is a company. It is an unlisted company, but it is a small company. So it is an unlisted small company which want to start the business, or which already have started the business, but you can and I can invest in this company. So what would be the benefits if I invest in this company? Definitely government is going to give me some benefits if I invest in this company. But before investing in this company, I need to know that what is this company dealing about. I mean, we need to know some information about it, right? So let's see, what is this company? If we are going to invest in this company, then we will see the benefits of investing. So EIS is a company which is unlisted. So first of all, most important thing is to know if it is listed on a recognized stock exchange or not. But unfortunately, this is an unlisted company. So what does listed and unlisted means? At this level, I assume, and I am sure you know what listed and unlisted means. Obviously, if a company is listed on a recognized, say for example, LSE, London Stock Exchange, then obviously it will be more reliable than the one which is not listed. So this company is not listed, it is unlisted company. As I said earlier, this is just a small company, right? So it is unlisted company, but it is trading company, right? So it is trading, it is not investing company. So unlisted trading company, and it is small company. As I earlier said, it is a small company, and small means that it has less employees. So it has about 250 or less employees working for this company. I assume that you will appreciate the fact that if 250 or less employees are working for a company, then it is a small company, right? Another thing is that it is a risky company. It is a risky company or risky investment. Risky investment, because it is a small company, so I assume that it would be risky to invest the money in. It is unlisted trading company, small company with less than 250 employees, and it is risky as well. Why would I invest in this company? What benefit is the government giving me? Yeah, government is giving me some benefits. Government says, hang on, let me write it down first. 30% of investment. Government says, whatever you invest in this company, I will give you a tax reducer of 30% of the investment. Say for example, if you invest £1,000 in this company, £1,000, if you invest £1,000 in this company, then 30% of £1,000, excuse me, it comes to £300. So £300 will be deducted from your final tax liability. £300 will be your tax reducer. Say for example, you're going to pay to HMRC your final tax liability, but then you thought, I invested some money into EIS. Yeah, I got some tax reducer. I need to deduct that out of my tax liability. Then whatever my final tax liability is after tax reducer, that is what I am going to pay to HMRC. Right? So that is a benefit of investing in this company, that 30%, whatever I invest in this company, I will be eligible for a tax reducer of 30%. We will see a little bit more details about this company in our notes in a minute. But for now, if you invest something in this company, you will get 30% of a tax reducer, which you can deduct from your tax liability. Right? So that is EIS. It is a risky company. It is small company, unlisted company, and you can get the 30% tax reducer if you invest something in this company, right? Another thing about this is, although it is small company, one hint is that it has 250 or less employees, and it has 16 million or less gross assets. 16 million or less than that are its gross assets. So there will be two indications. Now, whatever I'm writing down here, this is very, very important topic as far as exam is concerned of P6, because this is the stuff which you haven't studied at F6. So examiner would expect you to examine this in the P6 exam, because he knows that you haven't studied it before, and it is very, very crucial from the exam point of view. Right? Obviously, after passing this exam, if someone comes into your office and say, I want to reduce my tax and I have some extra money, could you please tell me any tax efficient investment schemes where I can invest some money to reduce my tax? What would you come up with? Obviously, either EIS or SEIS or VCT, right? Which we are going to see in a minute, other two. But first one is EIS. So that is the benefit of investing in the scheme, that you get 30% of investment, and that will be tax reducer. What is the other scheme? Another one is called SEIS, or Seed Enterprise Investment Scheme. If you check on your notes, Seed Enterprise Investment Scheme. If you can't find in your notes, I will tell you where they are. But just keep your concentration on the board for a minute. Second of the scheme is called Seed Enterprise Investment Scheme. Now, what is the difference between these two? I told you that other company, EIS, was an unlisted company. This company is also unlisted. This is unlisted company, and this one is also trading company. Unlisted trading company. What else? This is unlisted trading company, but it is very risky company. Very, very risky. Why is it very, very risky? Although that one was risky, wasn't it? That one was risky investment, but it is saying here it is very, very risky. It is even riskier than the EIS. Alright? So how is it riskier? Because it is unlisted. But that was unlisted too. Why is it more riskier? Yeah, it is tiny company. It is even smaller than the earlier company. It is even smaller than EIS. EIS had 25 employees or less than that, but it has got 25 employees or less than that. 25 employees or even less than that. So I hope that you know, if a company has 25 employees or even less than that, how small would that company be? That would be very, very small, very tiny company. Right? So it has 25 employees or even less than that, and it is unlisted trading company. So this is very, very risky company because it has got about only 25 employees. All right? But if it is riskier than EIS, why would I invest in this company instead? I should invest in EIS because that is less risky company. Is government giving me extra benefit of investing in SEIS? Yeah, government is giving me 50% tax reducer. 50% tax reducer. If you know that here in EIS, the government was giving me 30% tax reducer, whereas in SEIS it is asking me, if you go and invest in SEIS, whatever you invest, 50% of that will be your tax reducer. You can get a massive amount in the tax reducers if you are going to invest in this company. All right, that is 50% of tax reducers. All right, so that is a SEIS, or Seed Enterprise Investment Scheme. That is very risky company, even tiny company than EIS, because EIS was small company, but SEIS is tiny company. It's a very small company with less than 25 employees. All right, so these are two companies. We'll see details of these two again when we move to our notes, but this is just an introduction of these two schemes. All right, another company, apart from these two here, another company is called VCT, or Venture Capital Trust. All right, Venture Capital Trust. Now, this is a listed company on London Stock Exchange. This is listed on London Stock Exchange, and it is a trust. It is a trust which is listed on London Stock Exchange, but it invests in small unlisted companies. Right? How does it work? Now, although VCT is listed, but when you invest in this company again invests in these companies. Again in these companies. Right? Although you are going to buy the shares in VCT, Venture Capital Trust, but when you buy the shares in this company, although this is listed company, but this again is going to invest in these two companies, or these type of companies. All right? So what is the benefit if I invest in this company? One benefit, if you see that this is a listed company. So what does listed mean? Listed means it is listed on London Stock Exchange or a recognized stock exchange. So it means that your investment is safer than in these two. But hang on, why is it safer? Because this company, VCT, is eventually going to invest in these two companies anyway. So why is this one safer? Yeah, because although you are going to invest in VCT, but that company is not going to invest in single EIS or SEIS company. It is going to invest in various companies. It will buy some shares in one EIS, it will buy some shares in another EIS, it will buy some shares in other SEIS, and some in another SEIS, because there are many EIS companies in the UK and many SEIS companies. So it will go and it will invest in many companies, not in just single company, right? So when it invests in many different companies, when it spread its investment in many companies, then the risk will also be spread, because you are not only investing in just single company, you are investing in many companies. Then obviously the chance of being bankrupt of one company is greater than chance of being bankrupt of all the companies. When you are going to invest in EIS or SEIS, you are only investing in one single company. If that company goes bankrupt, you will lose your investment. But if you invest in VCT, it is investing in many companies. Even one of that company goes bankrupt, that VCT won't feel any harm, because it has investment in many different companies. All right? So that is VCT for us, Venture Capital Trust. Now these are three companies, as I said earlier. What you need to do is you can buy shares in these companies. Excuse me. When you buy shares in these companies, whatever your investment is, government give you some benefit on if you invest some money in these, and in the shape of tax reducers. Here it was 30%, here it was 50%. What is the benefit of investing in VCT? It is again 30%. So 30% of whatever you invest in VCT, it will go to your tax reducers, and it will reduce your eventual tax liability. So you will not be, you will have to pay less tax than you normally pay, because it will reduce the tax liability. All right. So till here it is fine. we'll need to see a little bit more about these three schemes. I will now pick my own iPad and I will share it with you on your screen. Now if you have downloaded your notes already, that's fine. If you haven't downloaded, please make sure you download it and come to your notes, please. I will share it with you on the screen as well so that you can see. There you go. I hope now you can see on your screen. That is Enterprise Investment Scheme. Now EIS, this one it is, Enterprise Investment Scheme. I'm reading it from the notes. The Enterprise Investment Scheme is a scheme designed to promote high-risk unlisted trading companies. As I said, it is unlisted trading companies raise finance by issue of ordinary shares to individual investors. As I gave you the earlier example, if I am a small business, no one is going to invest in my company. I need some money. How would I raise some money? By making it as EIS. And then the government is giving people some benefits to invest in my company. Then the people will come and invest in my company because I have EIS company. Alright? So EIS will issue shares to many different people, and it will be ordinary shares as it says here. After that it says EIS investments are high risk. Right? Why? These are risky companies. As I said, very risky investments. Are high risk because investments are made in unquoted companies. Why it is risky? Because these are investments in unlisted companies, unquoted companies, which have less than 250 employees. I told you that it is a small company which has 250 or less employees. And gross assets of 16 million or less than that. Alright? So 16 million are gross assets, as it says in the notes. Now after that it says income tax relief. Now there are two types of relief. First I told you the income tax, which I have just told you. There is another benefit as well, which is CGT relief, which I will tell you in a minute. But this is this is income tax relief, which I just explained you on the board. Now it says in here on the notes, individuals can claim a tax reducer of 30% of the amount subscribed for qualifying investments. So whatever you invest in these companies, EIS, you will get 30% tax reducers on that. Alright? Remember, again it says, remember, tax reducers can only reduce the tax liability to zero, but it cannot go into negative. So whatever your final tax liability is, and after putting the tax reducers, it can only make your final tax liability to zero. It cannot go into negative, and it is not repayable. Just like the dividends I told you from in the earlier lessons, if you remember. All right. After that, it says the maximum qualifying investment in EIS is £1 million. I did not show you here. So maximum you can invest is £1 million. You cannot go and invest and then keep investing in EIS in order to get the tax reducers. The maximum you can invest is £1 million in a tax year 15-16. Alright, that is for our current year. However, what you can do is, if you want to invest more than £1 million, then the investment that you invest more than £1 million will be treated as invested in the previous tax years. Alright, so it says in here, maximum you can invest is £1 million in a tax year 15-16, on which tax reducer can be claimed. If a taxpayer wishes to invest in excess, if you want to invest more, then investor may claim to have shares treated as issued in the previous tax year and claim a reducer in previous years. There is a mistake here in the notes. If you want to rectify it, in the third line of these, what I just read, it says in previous tax year 15-16. It is not 15-16, it is 14-15, because previous tax year would be 14-15. So it will be treated in previous tax year 14-15 and claim tax reducer in previous year. So if you want to, the maximum you can invest is £1 million, but if you want to invest more than that, that will be treated, the shares will be assumed to be treated issued in the previous tax year, and you can claim the tax reducer in the previous year. Alright?